where the rich are going. I don't mean celebrities or influencers. I mean high net worth business owners, people with 1 million plus in assets, real liquidity, companies, property, founders and investors sitting anywhere from 1 million to 50 million. These are the people quietly changing countries, not because they're greedy, because the UK has stopped making sense for people who build and own things. So in this video, I'm breaking down where the rich are actually going and why. Not headlines, not hype, just real jurisdictions, real rules, real numbers. In this video, we're looking at Dubai. Let's be very clear about something. Dubai doesn't work for everyone. And that's exactly why it works so well for the right people. So Dubai works for high net worth business owners, founders, investors, people with companies, retained profits, dividends and deployable capital, typically 1 million plus in assets, often far more. It's not designed for PAYE only employees, people with no control over their income, people living month to month, people who can't change how they're paid. And that distinction matters. Dubai taxes consumption, not productivity. There's no tax on what you earn personally, no tax on salaries, no tax on dividends, no tax on personal investment income, and no tax on capital gains. What is taxed is business profits, modestly. Consumption, lightly. That's a very different philosophy to the UK. In the UK, the system assumes if you earn more, we can take more, and then some. In Dubai, the assumption is build wealth, invest, spend, and we'll tax you when you consume. At lower income levels, this doesn't change much, but once you're extracting 6 or 7 figures, the difference isn't marginal, it's structural. In the UK, money passes through multiple tax layers before it reaches you, and even after you die. In Dubai, those layers disappear. Same effort, completely different outcome. Dubai does have corporate tax. It's 9% applied to larger businesses above the threshold. It's flat, it's predictable, and it's transparent. There's no frozen thresholds, no bracket creep, no surprise temporary taxes that quietly become permanent. You know the rules and they stay put. This is why Dubai keeps coming up, because people aren't just comparing tax rates, they're comparing certainty. Certainty beats optimization every time. Dubai isn't a loophole, it's a jurisdiction that made a clear decision about how it treats capital. And for people who've spent decades building wealth, that clarity feels like oxygen. But, and this is critical, Dubai only works if it's done properly. Residency, substance and structure. Get those wrong and Dubai doesn't save you, it just gives you new problems. This is where most people mess it up. They think moving to Dubai is a location change. It's not, it's a status change. People think, I moved to Dubai, therefore I stop paying UK tax, and that's just not how it works. The UK doesn't tax you based on where you say you live, it taxes you based on residency, ties, where decisions are made, where income is controlled. You can sit on a beach in Dubai and still be fully taxable in the UK, and that happens more often than people realise. Mistake number 2 is ignoring the UK ties. Things like family still in the UK, property available here, children in UK education, time spent back home, UK bank usage, UK directorship, behaviour. All of this matters. You don't leave the UK with a flight, you leave it with planning. Mistake number 3 is not dealing with the company properly, and this is the big one for business owners. Your UK company doesn't magically stop being UK taxable just because you moved. If the company is still managed and controlled from the UK, decisions are still being made there, nothing has changed structurally, then the UK tax net stays exactly where it is. Worse, you can end up with double tax exposure, UK scrutiny, foreign compliance, and no clarity. Mistake number 4 is moving first, thinking later. This is the most expensive mistake people relocating emotionally do, and then try to unwind structures after. That's backwards. The clean way is to plan, restructure, create optionality, then move. Not the other way around. Dubai gets sold as a lifestyle, not as systems. So people focus on visas, apartments, schools, Instagram, and completely ignore tax residency rules, management and control, exit planning, long-term structure, and that's how people end up disappointed. Dubai doesn't fix bad planning, it rewards good planning. So if Dubai isn't a quick fix, what does doing it properly actually look like, and where does restructuring fit? So what does doing Dubai properly actually mean? It's not a move, it's a sequence, and the order matters. Step 1. Before anyone relocates, we get clarity, not just on tax, on life. We ask, where do you want to live in 10 to 20 years? Are you building or preserving? Do you want flexibility or permanence? Are children, property or succession in play? Because Dubai is a tool, and tools are only useful if they fit the job. Structure before residency. This is where most people get it wrong. You don't move first and figure it out later. You structure first. That can include separating trading from assets, introducing or adjusting a holding company, deciding what stays UK based and what doesn't, planning how profits are retained versus extracted, cleaning up shareholder and director positions. This gives you control, and control is what makes relocation work. Step 3. Residency done cleanly. Once the structure is right, residency becomes straightforward. You establish clear tax residence outside the UK, reduced UK tax ties, proper presence where you're moving, defensible positions if questioned. This isn't aggressive, it's compliant, and that distinction matters. Step 4, extraction changes. This is the part people feel immediately. When you're no longer UK tax resident, the way money reaches you changes. Dividends land differently. Investment income lands differently. Your personal tax exposure drops, often dramatically. The company may still pay corporate tax, but the personal layer disappears, and that's the whole point. Step 5, deployment, not consumption. At higher net worth, smart people stop extracting everything, they deploy. Retained profits get used to invest, acquire, lend, hold assets, build long-term wealth. Dubai works best when you're thinking like an owner, not a spender. Dubai isn't about paying less tax. It's nice, but it's about regaining control over when, where and how you're taxed. And that's also why Dubai doesn't work for everyone. So let's talk about when it doesn't make sense and what to do instead. Dubai isn't always the answer, and pretending it is can do more harm than good. There are very real reasons Dubai not be an option. You might have family in the UK, elderly parents, children in education, care responsibilities, businesses that genuinely need UK presence, or simply lifestyle. Like, I don't like the heat, and that's fine. Because here's the part most people miss. You don't need to leave the UK to regain control. You have options. You can stay in the UK and change the structure. If you stay UK based, the question becomes, how exposed are you personally? Most people are overexposed because everything flows straight through them. So instead, we look at reducing personal extraction, increasing retained profits, separating trading from assets, using holding companies, changing how and when money reaches you. This doesn't remove tax, but it removes pressure. At higher net worth, extraction becomes inefficient, so the focus moves. Rather than pulling profits out and losing half of that to tax, you deploy capital inside the structure. That can mean investing, acquiring businesses, buying assets, lending, building long-term positions, making your money work, not leak. Next option is you could reduce your UK personal footprint. Even without leaving, you can reduce exposure. Less salary, fewer dividends, more time thinking in decades, not tax years. This is how people stay UK based and still compound quietly. Next thing is we can keep mobility open, and crucially, structures are built so that if circumstances change, you're not trapped. Because the worst position to be in isn't staying, it's staying without options. This isn't about Dubai versus the UK, it's about designing a structure that works in both. And that's exactly why long-term planning beats reaction. Whether you move or don't, the work happens before the pressure arrives. And this isn't theory for us, this is what we do every single day. We work with high net worth business owners constantly making these decisions, staying in the UK, moving to Dubai, moving to Paraguay, Uruguay, Isle of Man, or building structures that work in both. We run the UK side for our clients, we clean up exposure, we restructure, we decide what sits where, how profits flow, how assets are held, and where it makes sense we use holding companies, trusts, succession structures, long-term planning vehicles, not to be clever about it, but to be very intentional on the direction of travel. We also have an extensive global network, and that network has one job to do, to help high net worth individuals plan for a better future, whether that future is here in the UK or in places like Dubai. It's not about chasing tax savings, it's about designing a life and a structure that actually holds up over decades, not individual tax years. And because this is bigger than one video, we're building a private school community to map this properly, from foundations to extraction to deployment to structuring to trusts to global mobility. If you're thinking long term and you know the old rules no longer apply, join the waitlist. The link is in the description. No hype, no panic, just serious planning for people who've already built something worth protecting. I'm Sarah from Tax for Pros, building wealth, not just businesses. Thanks for watching. I'll see you in the next one. This is a whole series, so stay tuned.